Hi, everybody. Thanks for coming. We're going to walk through a few different term sheets, but let's keep this pretty informal. So if you have a question, we can deal with them real time. Just raise your hand and we'll incorporate them into what we're talking about. So Pat and I are startup lawyers. We work with young technology companies day in and day out. That's the bread and butter of our practice. We work with companies that are just getting started, so helping two founders incorporate a company and get things off the ground. And we see companies through the journey of several years as they raise lots of investor money, as they build out their board of directors, as they hire and fire employees, as they do lots of commercial deals, maybe buy other companies. And then eventually, if all goes well, we see them through an IPO or a sale. So it's a fun practice. And we see lots of really cool technologies and cool companies. So today we thought we'd walk you through a few different types of term sheets that you'll see kind of in the early stages of a company. And so these are three different structures we'll talk about, but all of them are geared towards raising money from outside investors. So you're probably attending other sessions here where they'll give you kind of the overview of what it means to set up a company and get your founder stock and do things like that. But this particular session is focused on bringing in outside capital, which most of our companies do, pretty quickly after setting up the company, because they need money to hire people and to buy computers and rent office space and grow the business. All right, so we're going to talk about three different types of term sheets. One of the term sheets, the first one we'll cover, is called a convertible note term sheet. Convertible debt. That's a structure that we use when people are raising generally less than $2 million to get started. We'll walk you through the terms, but it's a really quick and efficient way to get money in the door. And most companies that are raising less than $2 million to start typically use this structure. It's sort of similar to a safe. You're probably hearing a lot about safes these days in the market. Safes are sort of a convertible note structure that Y Combinator, which is a large incubator on the West Coast, that they've put forward. We prefer the convertible note structure, and we'll walk you through what that looks like. The second term sheet we're going to cover, so that's one structure, that's the convertible note structure, and as we'll explain, that money when it comes into the company is actually debt. And it later becomes stock in the company when you go raise a Series A later on, but initially it's debt. So that's one way to bring in capital. The other way is to just sell preferred stock right off the bat to your investors, where they become stockholders in the company on day one. And that is typically done when you're raising more than $2 million. And there's two different flavors. There's a true Series seed structure we'll talk about, which is really appropriate if you're raising, let's say, $2 to $4 million, so a pretty small priced round. And then we'll also talk about a full-blown Series A, so still preferred stock, but it's a structure we quite often see when you're raising $4, $5, $6, $7, $8, $9, $10 million to start, because as you'll see, it's a more robust structure, and there's more stuff that the lawyers spend time negotiating. And I think the theme here is, the more money you're raising, usually the more complex the term sheet and your legal documents are. If you're raising small amounts of money, you don't want to spend a big chunk of that on lawyers. It just doesn't make sense. So the smaller you raise, the more efficient you want your legal documentation and structure to be, so that you can take almost all of that money and spend it on building your business and not paying your lawyers and the investors' lawyers. All right, so let's start with a convertible note term sheet.
Okay, so as Kristine mentioned, the convertible note is generally the way companies will first raise capital. And so what we have here is a very straightforward term sheet for a convertible note facility for a company called Calculator that I invented last night, and it already has 3 term sheets, so it's been an unbelievable ride. So the note, at a high level, what it is it's debt that the company raises, and its debt has an interest rate like debt. It will accrue interest that at some point in the future will either convert to preferred stock or need to be paid back in cash by the company. Here, so the main terms are on this term sheet, and so right here we've got, this is a $1 million note round. So they don't necessarily have to raise $1 million. Calculator doesn't have to raise $1 million from one angel investor. They can raise it from a number of angel investors who will each have a note in a different principal amount. And those will all be under a note facility that has a note purchase agreement. So the 2 documents that you'll have are the note itself, which each investor will have a note, and the note purchase agreement, which governs the terms of all the notes. And that is handy because sometimes you need to amend notes, you need to extend the maturity date, or really, amend any of the other terms. And you can do that if you have a note purchase agreement, like by having all the note holders with the majority of the outstanding principal agree to the amendment. It's a good way of getting all the notes amended at the same time. So it'll amend all the notes under the facility instead of having to go one by one to all the people with a note out there. That's inconvenient. So this is an unsecured note. That means that the investors won't have any recourse to the company if they don't pay it back. That's generally how we see them at this stage. There's usually not much to secure the note with anyways. So security interest, if it's like, your mortgage is secured by your house. So in this case, the note would be secured by assets of the company. This note has an interest rate of 5%. That's pretty standard market interest rate. You don't see them oftentimes much higher than like 7, 8. That's getting pretty high. You have to be cognizant that in some places, and again, you wouldn't want to agree to a note with an interest rate that runs into this problem in the first place, but there's a cap under the law for the maximum interest rate that you can be charged, but that's rarely a problem. So as I mentioned, the note converts into preferred stock, and the most common way, and the way everyone will be most happy if it does convert in this manner, is on a qualified financing event. And when the note is negotiated, much of the negotiation is going to be around the terms here for what happens on a qualified financing. A qualified financing will be a financing in which a certain number of dollars is being raised by the company. So the investor have decided that if you guys are going to go out and raise, in this case, $2 million of new money, which is not money that you already have, it's new cash that you're going to get a wire for that amount. You didn't have it before, you're going to get it now. We'd like to join in, and we're going to do that by having the principal amount of the note and the interest that's accrued convert into the preferred stock that you're selling to the other investors at that financing. And so, but because you invested early, you took a big risk. Now you have the interest rate, which is supposed to address the riskiness of the loan on some level, but it also you get the bonus of a cap on the valuation of the company or a discount to the share price at the next round. So at the next round, the investors are going to buy shares for $1 a share, okay? And that is based on all the shares that were outstanding at that time, and you divide it by the amount of money being raised. So that's the share price. But the people who invested in the note round, in this case, only pay 80% of that, unless that 80% is higher than than the share price would be if the company only had a valuation of $5 million. So if in this case, calculator goes out and has a $10 million valuation, the note holders, well, they invested in a really early stage company, and they want the benefit of that, and so they don't want to be getting way less stock because the valuation shot up, in a way that they didn't expect before they raised the next round. So it's very beneficial to the investors, but it's a pretty standard term. And so what that does is you actually, for the note holders, you calculate what the share price would be if the company had a valuation of $5 million as opposed to whatever the higher valuation is that they're getting. And the note holders get stock at that valuation, that's priced at that valuation. And it can be a very significant discount in some cases. I mean, it can really be much, much lower than the people and the preferred investors, the new money investors are paying. And so
here's where you hear terms like capped note and uncapped note. Not sure if you guys hear those terms in the market. What an uncapped note is you forget about that. Sorry, you forget about an uncapped note is where you forget about that valuation cap, and it's just a straight discount. So whatever you manage to negotiate with your new investors at the Series A, your investors, it's uncapped. They just get the benefit of that discount. So 20% off whatever your new investors are paying. That's the most company favorable version, right? Because you're just giving people a straight discount. I would say we see that in the minority of cases. More commonly, we have what we call a capped note, so with a cap. And that's this formulation here, which is the investors get the better of that 20% discount or a valuation cap. So to Pat's point, if you manage to go out and raise money at your Series A to $10 million pre-money valuation, 20% off of $10 million is $8 million. If a $5 million is a better deal for your investors, so they convert in at the $5 million. So if you can raise money on an uncapped note, that's great. Most companies can't do that, but if you're a company that has a lot of demand and a lot of negotiating power, then you may be able to get away with it.
Yeah, the guys at Calculator, unfortunately, are not, like, it's the first time they're doing it. No one's giving them an uncapped note. They don't have the leverage, but it's okay because they sell calculators. Now, the other way the note can convert is if they don't, if there's a non-qualified financing, which is a financing that's below the threshold that they negotiated for the qualified financing. So it's raising less than $2 million. And in this case, and under this term sheet, now there are different ways this can work. I mean, this is a very straightforward term sheet. So, but and this is probably the most common formulation. You just get the preferred stock that is being issued in the non-qualified financing, the one that's for less than $2 million, and that's how you get your preferred stock.
But the chances of the company doing a price Series A where it raises less than $2 million would be that's very unusual. To my earlier point, you're typically not raising a price round unless you're raising more than $2 million. So that's why we usually set it at $2 million. But it could happen if things don't go well.
And then you see why these thresholds all matter: the valuation cap, the qualified financing. If you really don't think you're going to raise a certain number of dollars, you have to consider how that affects your threshold, where you're setting the qualified financing number. And then so another thing that can happen with the note is if you sell the company before you have a financing, which is, wow, that's great. I mean, that was fast. And again, there are different mechanics here that you'll see sometimes come into play, but a very common one here is the one we have here, which is that the company pays back the note plus 50% or some percentage of the principal amount of the note. So you get what's called like a sweetener on the acquisition of the company. Everyone's happy. They didn't get preferred stock, but what would they get preferred stock in? The company got sold, so you can't be issuing preferred stock in a company that's getting sold to someone else. Of course, it belongs to them now. They bought all the stock, so you just give them cash, pay them out, and so the term of the notes, here we have got 2 years. Now, something interesting about notes is that it has a maturity date, and the maturity date will happen. It's going to happen November 29th, 2019. These notes are going to come due. Could an investor, if Calculator is still sitting out there, hasn't raised any money, is still chugging along, working on their product, doing well, the company didn't just disintegrate and it's no longer there, it's still there, the investors, they could ask for their money to be paid back, but a more likely scenario is that they're just going to wait for the notes to convert, when they do raise money in the future. So sometimes founders will freak out when the maturity date comes, or they'll think, oh gosh, now I owe people money right away. You might, actually, if someone wants to do that, but a more likely scenario is that the notes will remain outstanding and convert on their terms in the future. You can amend the maturity date too. It's recommended to do that if you see that coming and say, hey, get ahead of the issue so people don't actually have the right to call the money back. But so that's a little interesting wrinkle there.
Because the practical reality is 24 months is a long time, right? Most companies, if things have gone well, they've raised their Series A in that time period. So if a company, and we see this, a company finds itself in the position where, let's say it took in $1 million under this term sheet, 24 months has passed, and for whatever reason they've not managed to raise a Series A, it probably means things have not gone well. That $1 million is long gone, I'm sure. And so, you don't have the money to pay back your investors. And they typically don't want their money back anyways. This is not an interest rate play for them, right? This is an equity play. So what we almost always see happen is, to Pat's point, the investors agree, okay, let's extend that another 6 months or a year, hope the company raises money, and then the notes will eventually convert. So that's almost always how things play out in practice. Otherwise, your investors, I guess, could push the company into bankruptcy, but there's nothing there to be had.
And then, so the last 3 things here on the term sheet. And so the notes can't be prepaid. That's another point that's interesting. You can't, once you've got, oh my gosh, everything went well, you sold so much product, and now you have all this cash in the bank, you want to get rid of these note holders and pay them their money back and their interest. You can't do that because they lent you money in the beginning when it was a risk. They want preferred stock, especially in a scenario where you've got so much cash, you're profitable, that you're going to be able to pay them back. Then they really don't want you to pay them back. They want the stock. That's like Kristine was saying, they want the equity in the company. The closing, so you don't have to, a lot of times what will happen is you'll have an angel lined up that'll be ready to give you a $500,000 investment, convertible note, but you're going to raise more, you need more, but you want to get that cash in the door right away. You can close on that note, and then you can close on other notes for some time period that you agree upon, so up to 6 months, up to like a maximum amount. And so that gives you flexibility to continue raising money under the same facility, on the same terms, very, very easily. And that's a term that is, it gives a lot of good flexibility there. Subordination, this means that if you borrow money from someone else, like a commercial lender, a bank, or something of that nature, the note is subordinated. That means that in a bankruptcy event or something like of that nature, the note is paid out after that money. The reason the notes are subordinated is because no bank is going to lend you money if the note holders are, if the note holders have priority to them. They're just not going to do it. So it's really, it's just a term you kind of need to have for business reasons. And then, like I mentioned in the beginning, the note purchase agreement, it's another document. It has in it, sometimes you'll see the company has to make certain representations, or there are other little deal-specific terms. But generally speaking, what that does is keep all the notes organized in one place, under one facility, and it gives people the ability to, the company the ability to, amend all the notes at the same time and take certain actions with all the note holders without having to interface with them all individually.
Just a practical point here. A term sheet it's a non-binding legal document. This is not the document under which people actually give you money and sign. This is just a document to help you get started so everybody agrees on what the key terms are. And once we have agreement on these key terms, then your lawyers are going to go away and actually draft the investment documents based on these key terms. But this is kind of the hard part, because this is the most important stuff. And so once you've agreed on these, then it should be pretty easy to pull together the legal documents based on these terms. But I've had some first-time founders who say, okay, I got a term sheet signed, and they think that money can come in the door, and it's actually, there's another step in between, which is actual legal documents that have to be drafted. Yes?
Do the note holders get any seats on the board of directors if it's not major?
Yeah, good question. So the question was, do your investors get any seats on the company's board of directors? That's something that gets negotiated. I would say 99 times out of 100, maybe 90 out of 100, we don't see a board seat with a convertible note. I have seen it occasionally where you have maybe a large note facility and it's a sophisticated institutional investor who wants a board seat. So I had one company that raised $10 million under a note right off the bat, very unusual, and it was from a VC fund who just so badly wanted into this guy's company that they were just willing to frankly agree to a note, but they wanted a board seat, so we negotiated for that. But most times, no, we don't see a board seat with a convertible note structure. Yes?
How does that work if your investor wants to disperse money over time? Like if you part upfront and then part on completion of certain milestones, do you still see it under the same convertible note? Does that change over time? Like how does that work?
Yeah, I would say that's an unusual structure. We do see it. But it can get complicated to paper, because then you get into things like, okay, well, what triggers that additional money coming into the company? Is it some business milestone? Is it just the fact that we've reached a certain date? So you have to make sure that that's really clear in the documents. And then is it just at the investor's option, or are they legally bound to invest? There's a lot to think about when you set up something like that. And I think it's hard for companies because they can't count on that money coming in the door. So I've certainly done them before, but it's not in the company's interest to really do that. I think if you can just get the money in on day one, that's much better for the company. Yeah. Did I answer your question? Did we answer your question? Yeah. Okay.
To extend the maturity date, what type, is that a negotiation what type of concessions would the startup have to make in order for them to extend the maturity date? Or is it just sort of goodwill?
Yeah, it's usually a goodwill gesture, and it's just a very practical reality that there's no money left, but the company's still active, it's still trying to raise money, and so the investors just sort of agree and cross their fingers. But to Pat's point earlier, when you have everybody under this one facility, then you don't need to go to everybody to extend that maturity date. You just need to go to 51% of the dollars, and they can bind everybody. So it's a really useful tool. Yeah.
I have a follow-up question to one that you asked earlier. I think if you're dealing with a corporate VC, say suppose in the biotech world or in the pharma world, say Pfizer, they say, okay, we'll give you $20 million upfront and $10 million if you pass, phase 1, phase 2, phase 3, and then they'll structure the deal. I think that's where Darsh is coming from.
Yeah, so you'd more often see that in a priced round. So we're going to get to those price rounds. Unlikely to see it when you're only raising $1 million. But you do see them. We call those milestone-based funding events usually. And so the key there is to really define as precisely as you can, okay, what is the milestone that has to occur for this investment obligation to be triggered? Is it FDA approval based on X, Y, and Z? Is it, certain traction in the market? But, the devil's in the details there, and what you want to avoid is getting to a situation where there's disagreement about whether the milestone's been hit or not. And I've seen that, where we thought at the time, we all looked at this document, companies' lawyers, investors' lawyers, the founders, and everybody looked at this and said, yeah, this is clear. And then, 8 months later, it wasn't really clear whether the milestone had been met or not. And then you're into this other negotiation about what's going to happen. So that's why, those are not ideal, because it rarely is crystal clear whether this obligation's been triggered or not.
And also to your question, that is most common in the life sciences, healthcare context for a few reasons. I mean, it does lend itself a little bit more nicely to a milestone. You can say that you identified certain markers of, depending on what you're doing, or you've got like a couple lead trials going on with, and so in the healthcare context, it comes up more often. And also it's because of I think in the large amount of money that you often need to get these companies off the ground. They're like $30 million rounds. They're big rounds, so they don't want to give you all the money up front, and then it doesn't go anywhere. So, yeah.
Yeah. Well, let me just add one point before we leave this. And I think this is something that people don't necessarily realize, but under the securities laws, for the most part, you only can raise money from accredited investors. There's been some change in the Jobs Act with some crowdfunding, but as a practical matter, that's just not an option for most companies. It's way too expensive. So at the end of the day, when you're raising money under a note or you're raising money under one of the other two term sheets we're talking about, you need to be raising from accredited investors. And so even if you're going to your friends and family, they need to be accredited. And the test is, it's not a huge test for an individual, so a real person. It's an income of $200,000 or net assets of $1 million, excluding your home. So it's not a huge test, but it's somebody of some means. And so you need to make sure that the people you're bringing in meet that test. And we have a questionnaire that we give our companies to give to their potential investors, to have them sign it to make sure that they meet the test. Because as a company, you have to take some reasonable steps to verify. You don't need to look at bank accounts and things, but you have to at least have people sign something where they're putting their neck on the line saying, yes, I'm accredited. So I think people forget this as they're in their early days raising money from their college roommates and other people who might not be accredited, and that will actually put you afoul of securities laws, which is not a good place to be. Should we do the next one?
The common stock, preferred stock thing on conversion, is that worth mentioning?
Yeah, so that's a good point. You want to explain that? Go ahead.
Sure, yeah. So one quick thing, this is a pretty technical point, but it's actually something that is important for when we represent founders. We always raise this because when the note converts into preferred stock, we're going to talk a lot more about what preferred stock means and what all of its rights are, and they have a lot. And and one of the things it has is called a liquidation preference, which means that if you invest $1 and you buy preferred stock worth $1 a share, and the company liquidates, which you can liquidate for any number of reasons, you will at least get back, or you will first, before anyone else, get back $1 a share. That's your liquidation preference. And that's just to protect the investor's principal. The notes, when they convert at a discount. So if the preferred stock is $1 a share, these note holders are actually getting preferred stock for 80 cents a share. But that 80 cents, they did not, so that means that they're getting 20 cents of what we call extra liquidation preference. That's not tied to any actual money that they put into the company. They didn't, which is in contrast to the preferred stockholders who paid exactly $1 a share for each share. So one thing that we often do to address that and to prevent people from getting free liquidation preference is you will have the note convert into preferred stock up to the principal amount of the note. So you will get preferred stock with the full liquidation preference equal to the dollar value of the note. So your dollars, you do get your dollars back on a liquidation event. And then the rest of the stock, because there is a discount, there will be additional stock, you get common stock, which has no liquidation preference. It gets paid out after everyone else. So that way, you give the investors a benefit of protecting their principal, but you don't give them 20% extra cash on a liquidation event, which is what they would get if they just got the same preferred stock. And it's like it's a bit of a technical point, but it's a handy one.
Yeah, and these are things as you're talking to so what we do, we we come up with a draft term sheet for our founders, and we sit with them and go through every term and talk about what's here and what the possible permutations are of that, and figure out what makes sense given, their appetite and who they're raising money from, and then we come up with what we think are, good terms. So you definitely want to be working with someone who understands what all the possibilities are here. And you don't want to make it too complicated, actually. You want to keep these simple. But even with the confines of keeping it simple, there's a few key things that you need to make a decision on and know what your kind of options are. All right, so yeah.
Sorry to interrupt. Just one question following that case. So in that case, if they get more common stock, do they have more equity, or do they have more voting right? Like, how do you calculate the equity?
So, at generally speaking, preferred stock, when you're thinking about something like voting, or is the same as it's one share of common stock, one share of preferred stock. They vote together on matters, and it's the same thing. And so, they don't get extra stock beyond what they're due under the note facility. How should I explain this?
It's just that part of it is going to come in common, and part of it is going to come in preferred stock.
But they were supposed to get the preferred stock,
Yes.
which has no voting right, right? But if they have more common stock, they will, have the opportunity to have the voting right.
The voting's the same across, think of it as the same across preferred and common. It's just the preferred has this liquidation preference in the event, frankly, things don't go well. And so what you're saying is if you put in $100 and it works out that you're getting a 20% discount, you're going to get 80 shares of preferred stock. And those additional 20 shares, which is like your discount reward, you're going to get 20 shares of common instead of 20 shares of preferred stock.
Just the common stock.
Yes. Yeah. So 80 and 20. So if all goes well, actually, if the company does super well, then the preferred and common will be worth the same. So you'll be, but it's if things don't go well, and we're in a scenario where the company's basically like shutting itself down and paying money back to its investors, then your $80 is going to have preference, but your $20 won't. Does that make sense? Yeah. Any other questions on the debt before we leave this and start to talk about a priced preferred stock round? Okay. So some companies, the first money in is the convertible note round we talked about, and I would say most companies probably start with that because many companies decide they want to take in a little bit of money, $1 or $2 million to help them get started, and then they'll push a priced round down the road. So some companies start with that convertible debt round, and then let's say 12 to 18 months later, they're back in the market doing this priced round because they've spent much of that first million or two, and they've made a lot of progress. Now they're raising more money, so it warrants doing a priced round. Some companies we work with, they just are raising way more money off the bat, and so they skip that convertible note round, and they go straight to a priced preferred round. It's really just a function of how much they're raising. And so, like I said, if you're raising north of $2 million, we typically see that it's a price preferred stock round, meaning you put a valuation on the company and you sell your investors preferred stock. Now, when you think about preferred stock, so preferred stock is what investors buy. Let's just take it back a step, actually. Founders and employees of the company, they generally get what we call common stock. Sometimes you'll hear things like founder common stock. That's just common stock. And common stock is kind of the simplest form. But I said if all goes well and you have a great exit, then the common and preferred are worth the same. But the preferred stock has lots of special rights and protections. And it's because usually investors buy preferred stock, and they're generally sophisticated. They quite often have their own investors. So a VC fund has its own investors it has to answer to and worry about. So preferred stock has special rights. It has special protections, special voting rights. And these are all negotiated. But the stuff we're going to lay out for you is kind of pretty standard for raising money from venture capital investors. So when you talk about preferred stock, you'll hear things like Series C, Series A, Series B, Series C. Those are just labels, really, but people typically tend to label their shares sequentially. So usually the first round is what we call a Series Seed, so S-E-E-D. The next round, if all goes well, is a Series A. Then you raise a Series B. Then you raise a Series C, and so on. And typically, if the company's doing well, every time you raise a new round, you're raising more money at a higher valuation. Things don't always go as planned, by the way. You know, sometimes companies hit bumps in the road. So you'll hear about things like a Series Seed 1 or a Series A1, which is like not a full-blown next round. It's maybe just like a little mini up round or something. So you do see, you know, the nomenclature change a little bit, but typically think of it as, you know, A, B, C, D, E, and that's just kind of later and later rounds. So it used to be, by the way, that Series A was always the first round. That's just the name people started with. Now I would say in the last 7 to 10 years, this concept of Series Seed has come into being. And it's really just a smaller, it's still a priced round. It's usually the priced round before you raise your Series A. Just labels though, so don't get too confused or intimidated by those labels. Yes?
We raise a sorry, no round, is there Series Seed, or is that just before Series Seed?
Yeah, people will say, it's confusing. People will say it's your seed round, but it's actually not Series Seed stock, if that makes sense. It's like the first money in, so it even gets more confusing, yeah. So when you talk about preferred stock, there's sort of true Series Seed, and what we mean by that is it's still that priced round, but because you're not raising a ton of money, so once again like 2 to 4 million, it's a slimmed down series of rights for your investors, with the goal once again of like getting this money in as quickly as and efficiently as we can, and we'll punt on some of these more complicated terms till you're out there raising $5 or $10 million down the road. And so Series Seed is supposed to represent this slimmed down set of rights, and so we'll walk you through a typical Series Seed term sheet. That being said, I have had companies say, well, we're going to raise a Series Seed, but they call it a Series Seed, but the docs actually look like what's more complicated later, and we'll lay that out for you. So, you know, not everybody's consistent in their labeling, but this is how we like to think of things. All right, so let's go through the term sheet, but stop me at any point. So this is Calculator still, and they're selling shares of Series Seed preferred stock, so that's the label we're putting on it. They're going to raise $3 million in total, and that is probably not coming from one investor. It's probably coming from a few different investors, but in the aggregate, they add up to $3 million. And by the way, if this company had done the 2 steps, so if it had raised that convertible note round first for $1 million, and now it's now raising $3 million, what this would probably say is $3 million in the aggregate plus the conversion of $1 million in notes. So you're signaling to your investors, we already have this $1 million on the books and it's going to convert, but we're taking in $3 million in new money. Purchasers, so once again, accredited investors. Quite often this will identify who the lead investor is. So if your lead investor is First Round Capital, it would probably say something like $2 million from First Round Capital and $1 million from other accredited investors, you know, approved by the company, something like that. Price per share. So the price per share is actually an output. So quite often the actual price per share is not even identified in the term sheet. What's more important is the formula to get there. And what that is there's a couple of inputs, but the most important one is what's the pre-money valuation? So what's the valuation that the investors are putting on the company today? And here we've said it's $10 million. So if you take that $10 million, and we do these models for our clients that help them understand all this, but if you take that $10 million and you divide it by the number of shares that are currently on the company's books, that gives you a price per share. Now, you do get into things like, well, do you count the notes in there, and what about the option pool? But, you know, at its simplest, it's like, what's the company worth today? What value are we putting on it? And how many shares does it have on its books? And that's the price your investors are going to pay. This is a negotiated point, right? So this is something, it's one of the key things that you're going to negotiate with your investors. And I have clients come to us and they say, well, what should our pre-money valuation be? And what should I tell investors it is? And we give them lots of comps in terms of what we're seeing in the market, right? And there are these rules of thumb for like a Series A company or a Series B company. But at the end of the day, it's a negotiation point. And I always tell my clients, I like the investors to put the first number out there, because that then becomes the floor. If you as a founder throw out a number, then that's our ceiling, and they're just going to negotiate you down from there. But you know, that's just kind of negotiation strategy. I think one important thing to think about, though, when you think, and I don't know, does anybody here watch the show Silicon Valley? Okay, so you've seen it. They talk about this in a few episodes. Valuation is a little bit of a game in the sense that what you're actually trying to solve for is ownership percentage in the company. And so if you're talking about sophisticated venture capital firms, they internally have kind of ownership requirements that they have in mind when they're investing in an early stage company. Because they know, I need to own X today, because they're sort of modeling that you're going to do, let's say, 4 or 5 more rounds of funding, and they might invest a little more at each round, but they're kind of modeling where they'll end up at the end of the day, so they need to start at a certain number. And so usually what they're saying is, they typically want to own, or the round will own 20 to 25% of the company. So you can do the math, right? 3 on 10, 10's the pre. So it's 10 plus 3 is actually your denominator. What's 3 divided by 13? Is that 25%?
It's a little bit more.
Is it a little bit more?
A little less, sorry.
A little less. Okay. Somebody here is a good math person. But that's kind of how you think about it actually, is you're actually trying to solve for a percentage. So if you're raising more money, it means your pre-money valuation probably has to go up, or you're giving away too much of the company. Does that make sense? Because ultimately you're solving for an ownership percentage for the round. That's what people care about. So that's one of the most important economic things that gets negotiated, is what's the pre-money valuation and how much are we raising, and those are related. The other thing is, what's our option pool going to be? And the option pool is just a bucket of shares you're setting aside to do your future hiring. And the reason that this is an economic point is you need to most likely kind of increase the number of shares you're setting aside for that. But 99 times out of 100, the investors will say that increase, when you model it, is on a pre-money basis. So it's the founders that actually bear the dilution for that. And so as a result, it actually it affects your pre-money valuation, because it's taking it up or down depending on the percentage. And you'll see, a good law firm can help you model this. We build what we call pro formas for our clients all the time, which show all of these various inputs, and they can take the pool up or down and see how it affects their ownership. They're kind of really interesting models. But the option pool is an economic point because it affects dilution. The important thing to think about here is, many investors have these rules of thumb, or they claim they do, that they, at a Series A company or Series Seed, they want 15% of the cap table available for future hiring. And that number is supposed to represent enough hiring. So we're closing our Series Seed here, right? Let's say our Series A is 18 months away. That percentage should be enough of your cap table for you to do the hiring you need between closing your Series Seed and getting to your Series A. That's what that number should represent. And so for some companies, 15% might be the right number. But for many companies, that's probably too high. And therefore, maybe it's more like 10 or 8 or 12 or something. And so what I always tell my founders is, do an equity budget. Figure out, between closing this round and getting to your next round, who do you need to hire? Is it a CMO? Is it a CTO? Is it 5 engineers? Is it 3 salespeople? Make a list and figure out your best estimate of what you think the equity percentages are going to be that you need to be able to attract these people. And that's your number. It's not some number a VC came up with. It's what you actually need as a company. And for certain companies, depending on their needs, that's higher or lower. It may depend on how much capacity you have on the founding team, or where they need to go hire some of those things. So it's a super important point, and the best way to negotiate against a random number is to actually have this equity budget and say, look, I know you think it's 15, but we've actually done the math, and we think we only need 10%, and here's why. And it's very hard for an investor to push back on that, so it's really worth spending time thinking about your hiring plan. Okay. Liquidation preference. So we talked about this before. This is one of the key, oh yes.
I have a question. That percentage, how does it affect the investor? Like if it's higher, what's the effect of that? Or why wouldn't he want that?
Yeah, it's a great question. So the question is, how does that number, the percentage, affect the investor? They want it as high as possible because they're not suffering the dilution of getting to that number. It's being done on a pre-money basis. So they're going to push you to a high number. And then if you get to your Series A and you haven't spent it all, well, they're fine with that because they didn't suffer the dilution. But you shouldn't be, because you unnecessarily suffered too much dilution. So it's this kind of dance where they want the number higher and you want it lower or more reasonable. And so the goal is to come up with something that's actually kind of accurate. Does that make sense? Yeah.
What happens if you don't use the full amount? Does that you put it back into?
It's just going to sit there, yeah. But when you get to your Series A, you're back to the same negotiation. If the Series A investor is going to say, okay, how much do you need between A and B? And that's, usually the number gets smaller because you're not doing as much hiring. And if you already have some there, then you don't need to make as much of an increase to get to that percentage, yeah. I don't think people focus on this number enough, by the way, and how it really has a huge economic impact on the founders. And that's why you need to do these models or have someone build them for you so you can actually see the trade-offs between a 10% pool and a 15% pool and a 10 million pre and a 12 million pre. And we build them so we list out our founders name by name, and they can actually see, oh, I go down to this percentage with this decision, or I go back up to this with that decision. It's very impactful. You agree with that, Pat?
Oh, yeah,
Yeah.
absolutely. When people see it, then it hits home. You see
Yeah.
58% start turning to 30%.
Yeah.
And then, it obviously, as you go on, it gets lower and lower.
Yes.
If the VCs are planning to own 20 to 25% in each round, and the company
No, in the first round. And
the company doesn't want to lose ownership, giving 51% to the VCs, coming from a company's perspective, how do they want to prevent that from the VCs owning the company and the company keeping the majority of the share, the owners?
Yeah, so I wouldn't think about it that way necessarily. I guess I have a few thoughts. One is that 20 to 5% is for the first round. It does get smaller as the company's growing. And the theory is, look, you're giving up a lot of ownership in the company, but the value in pie is getting bigger. So you're owning a smaller piece of a much more valuable pie. That's kind of how you need to think about it. And really, when you kind of see how these documents come together, maintaining kind of 51% is actually not as important as people think it is, because you're giving the VCs lots of other controls, and they're going to have the right to block certain things in any event. So that focusing on that 51% number is, it can be important for some purposes, but it's not a be-all and end-all, actually. I think it's more about taking in the right amount of money, taking it in from the right investors who are going to add a ton of value. And even though your ownership percentage is decreasing, the company's becoming much more valuable, so your wealth creation is actually growing. Yeah.
Are there any companies that are doing it like the old school way of just going to a bank and taking a loan and kind of going through that way, or is it almost all equity-based nowadays?
Yeah, I suppose there's some companies doing it that way. I think that's an unusual path. But I think, for some companies that makes sense. I think it's hard to get a bank loan, though, as an early stage company when you don't have any assets to secure them against and you probably don't have any revenue. So that's the tough part. I think you'll see some companies that can bootstrap themselves, and maybe it's companies who actually sell things so they get to revenue quite early. I worked with GoPro for a long time through their incorporation, through their IPO, and they're an interesting company because actually for a long time nobody would invest in that company. And the founder said, okay, I'm just going to go sell more cameras. And he sold cameras, and he got a little bit of family money, and he had revenue, and did one round of funding shortly before the IPO. But that actually kind of wasn't by choice. I think he would have preferred to have taken investor money early, but nobody would give it to him. But at the end of the day, it actually kind of worked out well for him. But yeah, I think the reality is it's hard for some companies to get other funding. It also depends on the kind of business you're building, because I think at least, the right VCs bring way more than just capital to the table. They can really help you grow the company exponentially, the right VCs, because many of them are former entrepreneurs or operators. So they join your board. The right investor will roll up his or her sleeves, help you with hiring, help you with customers, help you with recruiting. So you're getting way more bang for your buck than just the $10 million they put in. But not all investors are the same. So, in fact, when I talk to founders, I don't think taking the highest valuation should be your most important thing. I think you need to look at who the investors are, and maybe the right decision is a lower valuation from a better investor. So, I think it just depends. The companies we work with are the companies that tend to be venture-backed, who are raising a lot of investor money. But there are people out there building really great businesses who never take a dime of venture capital money. You want to add anything?
No, yeah, just that
With
your point about the VC should ideally be a partner that's going to help you, not just someone who's trying to get a percentage of your business and not do anything to help you. So a loan is doesn't have the benefits of someone who cares and has connections in the industry and knows what they're doing, who can actually help the company grow.
Okay, so liquidation preference. So we touched on this earlier, but this is some downside protection for your investors. This is the simplest form. This is called 1X non-participating, which is the most simplest kind of company-friendly version of this. And what this means is when the company is liquidating or being sold, the investors have protection on that 1x, so they're the original amount of money they put in. But they have a choice to make. They can either take that original money, that original investment, and that's it, and they're on their way, or they forego that and they convert to common stock and they participate as a common stockholder based on their percentage ownership of the company. So this is not actually like a choice they make. The math on an exit will tell everybody what the result is. But the thing here is that on a low dollar exit, your preferred investors get paid first. And that's their economic protection. But if all goes well, then they will forego that, and they'll participate along with you, the common stockholders, based on whatever percentage of the company they own. So this is just a function of, is this a good sale or not a good sale? That's 1x non-participating. What you do here, like in some markets, and we saw this probably 7 or 8 years ago, we like 2x liquidation preference, and that's they don't just get that original amount, they get 2x. You hear things like participating preferred, and what that means is basically your investors get to double dip, so they get to take that 1 or 2x off the top, and then they convert and participate as common. That is very punitive to the founders and the team, because all that first money goes out the door before any of the common stockholders get anything. So, I think in 95% of the deals we do, it's 1x non-participating. It's very standard and simple. But this is a function of market economics. I will say, though, and this is, I think, counterintuitive to what people think, the best VCs out there have the simplest terms, actually. It's kind of the opposite of what you'd think. You'd think, oh, a big bad VC like Sequoia or Kleiner, they negotiate hard for all this crazy stuff. They actually don't. They're very founder-friendly, founder-aligned. They want simple terms because they want to incentivize the team to have a big exit. They also understand that there are going to be later rounds of funding. And the terms you set in your first round become the precedent for those later rounds. And so if you keep it simple early, then you have a good framework that you're working from later to keep it simple in your A and simple in your B. But if you start to agree to kind of off-market wonky things early on, it's very hard not to give your later investors that. And pretty soon you've just got a stack or a cap table that completely demotivates and is not incentivizing at all to your founders and your team. That's a liquidation preference. Conversion, so the preferred stock is convertible into common stock. And in this good exit scenario, that's what will happen. They'll forego that liquidation preference and they'll become common stockholders. Okay, voting rights. This is a very important thing to focus on. So if all goes well, the preferred stock has 1 vote, the common stock has 1 vote, and you kind of add them all up, and that's your denominator for what you need to get approval for. That's kind of the base you're working from. But the preferred almost always negotiate for special voting rights, and we call these protective provisions or veto rights. And it's a list here of things that you won't be, as a company, be able to do unless your investors say it's okay. And they're big things. They're things like raising another round of funding. They are things like declaring dividends, selling the company, the big material things. So you are giving your investors a block on your ability to do those things. So they can't force you into a financing or force you into a sale, but they can stop you from doing one. And so this is really important to appreciate because that's a lot of power to hand over to someone who only owns maybe 25% of your company. And this goes back to my point earlier about making sure you have the right investors on your cap table, because you want people who who are good corporate citizens, who understand the venture world, they understand how things play out. You don't want someone who has these rights who doesn't have the right incentives or reputation or motives. So while this is a very standard list, it's very powerful, and so you need to appreciate kind of what you're handing over to somebody. Okay, documents, this just says, we're going to, once again, this is just a term sheet. We're going to go away and draft these legal documents. Participation right. People call this pro rata rights, ROFR rights, ROFO rights. You hear this, there's different labels for it. What it really means is you're giving your current investors the right when you raise future money to buy a little bit of that new round. So your Series Seed investors will have the right to buy some of your Series A, and that's very standard. Sometimes you give this to everybody. More often you limit it to kind of what we call major investors, so people who wrote kind of the big checks, and you kind of want to draw the line somewhere. There's no right or wrong about where that line goes, but quite often if you look at the investment amounts, there's usually kind of a natural break point. But I would say typically at this stage, we would see people set at like $100,000 or $200,000, something like that. Because you don't want all these little guys to have all these, someone who wrote you a $25,000 check shouldn't have the same rights as somebody who wrote you a $500,000 check. So usually you see some distinction here. Okay, the next thing is board of directors. I would say this is at least as important as the economic points we talked about earlier. And I think some founders don't focus enough on this. So does everybody know what a board of directors is, by the way? Back up. So it is the governing body of a company, right? It is 1 to maybe 5 or 7 people. They're natural, real people. They're not like the fund itself. It's actually real people who sit on the board, and they make key decisions about the strategic direction of the company, and they have to improve the important things the company is going to do. So it's a ton of power. And at the very beginning, the board is probably just the founders, 1 founder, 2 founders, 3 founders, however many there are, and it's kind of perfunctory. You'll just kind of approve everything in writing. But as the company grows, that board takes on more significance. You're going to have regular board meetings where you're going to talk about the strategy. And most importantly, kind of anything important the company is going to do, the board of directors has to approve. The most important thing the board does is it hires and fires a CEO. And so when you think about your board, you need to think about who controls the board of directors. If you have 5 seats, you need 3 out of the 5 to act, because the board can act by majority. So you need to think carefully about who controls the 3 out of the 5, because they effectively, that's a lot of power in terms of deciding what the company will and won't do. So I think it's something that some founders kind of just like breeze over, but it's super important to think about your board structure. So here, for example, this is a 3-person board, and it's one director elected by the holders of the common stock, so that's probably going to be the CEO or one of the founders, 1 by majority of the Series Seed, and 1 by mutual consent. So really nobody has control with this board structure, right? Because the preferred has a seat, the common has a seat, and they both need to agree on the 3rd seat. We put this in here as an example. I try not to have my founders do this. I'd rather see like 2 common and 1 preferred to start, so you retain founder control. But I think what's the message here is this is something you have to be very thoughtful about. You need to talk to your counsel about it, and every time you raise money, the board gets reopened, and you're back to discussing what is the control. And it may not be realistic as founders to keep control for the life of the company, but certainly in the early days, I think for the first round or 2, I've seen many founders successfully retain control. And then you see some companies like Facebook where I think Mark Zuckerberg still has control. So this is all a function of negotiating power. Yes?
Actually, we're actually dealing with these problems right now. Like, do you think it is necessary for us to have like the supermajority voting right to protect our future company? Because I know investors hate that.
Yeah, well, I think it's lost. It was popular for a while. It's lost some favor post Uber. I think it's more unusual to see, we call this dual class. He's asking about what we call dual class or high vote, low vote stock. It's where some shares have way more voting power than others. So you see some shares that have like 10 votes a share, and other shares only have 1 vote per share. I think it's more common to see that put in place on the eve of an IPO. Companies like, that's what Facebook did, what Google did, for example. I think you do see it sometimes put in place a bit earlier on. I'm not a huge fan of it. I think you can solve for some of the same things with your board control. And I think it has lost favor in the investor world because it's played out not so well in a few pretty high-profile cases. But founders ask about it. My view is I'd rather keep things simple, and I think if you're building a super valuable business, you have a lot of de facto control that way because you're just so valuable to the company. But yeah, it's a complicated issue. Okay, expenses. So this comes as a surprise to people. It's the convention in the venture world for the company to pay at least a portion of the investor's legal expenses, which kind of seems silly, I think, in a way, because they're writing you a check and then you give them back a little bit of that to pay their investors, but it is standard. And in the Series Seed, you're reimbursing so not every investor, you're investing one set of counsel for all the purchasers. In here it's $10K. On a Series A round, it's probably $35K. A Series B, it's like 50. You know, it goes up because every round gets more expensive from a legal perspective. And a good rule of thumb actually is whatever the investor reimbursement is, so that's what you're giving the investors to pay their lawyers, the company's legal fees are probably about 2x that. Because a company has to actually do more work during the transaction, and so your own legal bill is going to be more. But you got to just budget. You're paying your own lawyers, and then you're also going to pay some portion of the investor's expenses. Future rights. So this goes to the fact that these are kind of very slimmed down Series C rights. And so this is an acknowledgement. Look, when the company goes to raise its Series A, and we put in place those more robust investor terms, which we're going to talk about next, these Series C investors, they get the benefit of those rights. So they're saying, look, well, we're happy with the slim down rights right now. We're only investing $3 million. But when you go raise a $10 million Series A and you have like the full suite of investor rights, we'll get those as well. That seems fair. Okay, second last point, key holder matters. Key holder is just another word we use for founders. And this touches on founder vesting. So, founders get common stock, and it's almost always subject to vesting, and that's something you'll have a discussion with your lawyer about when you incorporate the company. And one of the most important reasons to do it is not only to give yourself protection vis-a-vis your co-founders, but investors really care about this. They know that the value that you're creating is in your stock, and they want to make sure that you're incentivized to stick around to see that value being created. And so they care about what your vesting schedule is because they want to know that when they put their money in, you're still incentivized to stick around for several years after. So this is why you see it in a term sheet. And what this means is if your vesting doesn't line up with this, then you need to change it to line up with this. So when we talk to founders and we're incorporating companies, I hear some founders say, you know what, I don't want any vesting on our shares. I'm going to deal with that later when we bring on investors. I actually think that's not a good idea. One, if you have co-founders, you have no protection vis-a-vis one of you leaving. And secondly, if you put in place something pretty standard to start, it's very hard for an investor to take issue with that because they can say, look, we incorporated the company, we all have four-year vest with a one-year cliff, we have double trigger acceleration, completely standard. It's kind of hard for them to argue with that, so they're just going to let it go. But if you don't have any vesting, then they'll probably be more aggressive with you on it, and it may be a little punitive actually. So, it just goes back to do what's standard when you start, and you're going to have less issues down the road. Last point. So there's a couple important points in this one. One is, this is not a binding term sheet. So this is almost all term sheets are non-binding. That's very standard. And what that means is everybody gets focused on what the key terms are, and then the lawyers go away and draft the legally binding definitive documents, which are probably going to get signed 3 to 4 weeks after this term sheet gets signed. But during that period, the investors want to know that you're not out there talking to other investors and shopping that term sheet. So one of the things that is binding is what we call a no-shop or exclusivity. And that just means, okay, you company have signed this, and I think this says 30 days. Yes, so for 30 days, which is kind of enough time to get your deal papered and documented and funded, you can't go out and talk to other investors. You can talk to other investors like to fill out the extra million or whatever, but you can't go talking to investors about a different deal. And you can't be showing other people this term sheet because we've invested time as an investor in negotiating this term sheet. They're getting their lawyers, going. They're spending money on diligence. They need to know that you're committed for 30 days to doing this deal. Now, if you get to 30 days and the deal hasn't closed for whatever reason, then you would be free to say, you know what, I'm going to go do another deal. The practical reality is if maybe closing slips by a few days, people just extend it to get over the goal line. But you have to realize that, signing a term sheet is serious because it means you're off the market. You can't be dating or talking to anybody else. It also means you're pretty stuck with these terms. I encountered one founder who came to me with a term sheet, and I said, oh gosh, some of these, we hadn't been working with them. They were switching to us, and I said, these things are really, some of the things you've agreed to are just a little crazy. He said, well, that's just a term sheet. We'll deal with it in the documents. And I said, that's actually not how this works. You've morally agreed that these are the key terms, and it's very hard to get your investor to move off of that because that's not what the deal is. So you have to understand that these are the key terms you're agreeing to, and there's going to be a lot of other smaller things you'll negotiate, but the most important things are here, and that's the deal that people expect you to do. Yes?
That only applies if a no-shop document has been signed by the investors and the founders?
Then you can't shop it around. Yeah, but I don't know that I've seen a term sheet without a no shop in it. Yeah. Okay, so that's the Series C preferred stock. We're now going to talk. Do we want to take a break, or should we just keep going? Okay, we'll keep going. We're now going to talk about, this is still preferred stock, but this is like a bigger raise, so it's more robust. So you may go from no money raised, and you decide we're raising $5 million, straight up we're going to Series A, the more robust documents. You may go from a convertible note to this Series A. You may do convertible note, then a Series C, then a Series A. We've seen lots of different kind of combinations. But at some point, you're raising $5 million and you're doing a Series A. And I would say a Series A raise these days, for what that's worth, is like $5 to $10 million. That's typically how much people are raising and when they're labeling it a Series A. So just a good market check there. So I think this is a good illustration because you guys, everybody have the term sheet. A term sheet's not a term sheet. I've seen Series A term sheets that are one page, and it would be like this, more or less. How many pages is this other one?
13.
And then there's Series A term sheets that are 13 pages. They're for the same deal. All it means is if you do the short form term sheet, you're kind of punting more to the be negotiated when you get to your long form legal documents. If you do the long form term sheet, almost everything is kind of set out here. There's less to be negotiated later. Whether you do, and then there's in between, I've seen ones that are 3, 4, 5, 6 pages, which kind of are like the middle ground between the two. So which is the right one? I think it depends on who the investors are. It depends on how quickly you need to move. I'm much more comfortable doing a one-page term sheet with a firm like, Sequoia, Kleiner Perkins. Name your tier 1 VC firm, because I know that they know what standard is. And so I know we're going to get to docs, and they're going to hire a law firm that we work a lot with, and they're going to be reasonable, and they understand what market is. I think if you're talking to let's call it a non-repeat player, maybe someone that we don't know as well, doesn't mean they're not a good investor, by the way, but they're not a repeat player or a good venture capital firm in the tech world, there's probably less agreement on what market or standard is. And with a fund like that, and they still might be a great investor, I'd be more inclined to hash things out in more detail at the term sheet stage so we all know what we're getting into. So, it just sort of depends.
So we'll just run through these initial set of terms quickly. Here you see that calculator. They're raising $5 million on a $15 million pre-money valuation. So it's 5 on 15, 20. They're going to have $5 million of a $20 million post-money company. So they're looking for roughly 25% of the company. That number is not going to be precise because here you see they have convertible promissory notes that they raised earlier that are going to convert at the same time. So that affects how all the percentages break down at the end of the day. But that kind of shows you what they're looking for. We've discussed, or Kristine has discussed the option pool, so I won't get into that here. And this is Series A preferred stock. It's commonly raised after your Series C preferred stock. They're raising. We've got one investor here who's already ready to go. It's Wishbone Ventures, very hot VC in the fake calculator startup world. They're going in for $1,750,000. I think that we'll call them the lead investor at this point. So the lead investor, they're the ones that they're going to hire the attorneys that are going to negotiate the documents. They're going to handle the entire process. Other investors are going to follow their lead. They'll have input oftentimes. But thankfully for us, because we generally represent the we represent everyone. But if you're representing the company, it's a lot easier to deal with one investor than 5 investors who all have different takes on things. So that's how that usually works.
And one point there, like lead investor, by the way, that's not a legal term. That's just kind of a term of art people use. But to Pat's point, it's the person you negotiate the terms with, and then the others just kind of follow along. You can't be negotiating with everybody. It's just not efficient. So you negotiate with a lead. It's usually the person who's writing a check for the majority of the round. So here would be like 3 out of 5. But sometimes, in this case, we just set this up randomly, but sometimes it's the person who's writing the biggest check. And so it's not a majority of the round, but it represents a single biggest investment. And we've done some deals, by the way, where I've had not a good process where we've dealt with a lead investors council and then counsel for 3 or 4 other investors, and that is the best way to increase your legal fees by tenfold. So that is not a good place to be. You want to have one investor, and your other investors can deal with that investor and its counsel, but as a company, you can't be dealing with everybody or your legal fees are going to skyrocket and it'll take forever. Sorry.
Yeah, so does that include like when you have one fund with multiple people going into it versus having like multiple funds all trying to do a single like valuation? In the sense that you have like multiple VCs working separately but all on the same deal versus one person who's just saying, I want to invest $10 million, I'm going to put $1 million up front and then find the other $9 million to kind of add into it.
Okay, so the question is, what if you have multiple people writing a check in the round? Is that sort of...
Right, so say like 3 VCs partner together to...
So that having several VCs partner together around would be pretty unusual, actually. Usually you have like one big VC, and then you might have like other angels or other people who maybe invested early. It'd be unusual to have like 3 named VC funds come into the same round. I mean, I've seen it, but that's a little unusual. But maybe you see it with like a bunch of seed funds who want to band together. I think in that case, they should decide amongst themselves like who the lead is, and you deal with them and let those guys sort it out in the background. Does that make sense? Yeah. Yes.
I have a question. This is regarding the legal structure. So if the company is paying for the investors' counsel as well, isn't it a conflict of interest regarding the rights of the investors versus the companies?
Yeah, it's a good question. The question is, if the company is paying for the investors' lawyers, is there a conflict of interest there? I don't think people think about it that way, because at the end of the day, what happens is you don't have any control over that relationship, and you as a company just send the investor a check at the end of the day. So when the round closes, what'll happen is the other firm, the investor's firm, will serve up an invoice, a one-pager, and it'll say $15,000, and the company writes a check either to the fund, who then pays its lawyer, or maybe to the law firm directly. So I think there's no question that while you're reimbursing them, it's their attorney-client relationship. And you have no influence over that. You have no influence over who they use. You're completely out of that, except for having to write a check at the end of the day.
And so just the last things here, they'll have an initial closing, and they can roll and close on the additional amounts over a 90-day period. And you'll see what they're saying here is that they need a minimum of $2.5 million in the door to close and issue any stock. And so that's maybe a way for Wishbone to protect itself from being the only investor in this round, to see that there's interest from others as well, or because the company is going to have financing needs, they need to raise a certain amount of money. So setting that threshold somewhere, but and maybe you're not exactly sure if everyone's going to participate, over the closing period or not, but you have at least an initial threshold.
Yeah, and this 90-day period is super helpful. I've had some founders say, no, we're closing all the money on day one. I think that's great. It almost never happens in practice because somebody's wire doesn't go through or somebody's CFO is traveling. And so just practically speaking, even if everybody's kind of ready to go at the same time, it almost always never all comes in on the same day. You have a bit of a lag time, even international wire or something. So you need this additional period. That's assuming you have everybody locked up. What's not uncommon is to have, let's say, out of a $5 million round, you have 3 or 4 committed, ready to go, and then the company's going to close on that and then go find the other $1 million or $2 million. We see that quite a bit as well. So, either structure works, but your lead investor will have a view on this. Pat put in this point that you need, $2.5 million to close, because Wishbone doesn't want to be the only one at closing, and then you still have to go raise over $3 million. They want to know that a certain amount of money is coming in the door before they'll write their check. And so it's just a communication issue. Your lead investor quite often helps you find your other investors, by the way. That's, they have people in their network that they do deals together with, and so they're often a great tool or resource for helping you fill out your investor syndicate. Okay. So these are the rights of the Series A. We've covered some of these before. So one is dividend rights. This is a little bit theoretical in most venture-backed companies. So a dividend right sometimes you see public companies where they pay a dividend every year. It's kind of like an annuity. It's this cash flow. You almost never have that with a young technology company because cash is so precious that every dollar is plowed back into the company to fuel growth. So what these dividend rights say is we'll pay a dividend if the board decides we pay a dividend, which is completely meaningless because it just pushes it to the board. And I think the hundreds of companies I worked with, I've seen one company declare a dividend. It's just not what how people use their cash. So we have this standard language, but it's really meaningless. You will see sometimes more East Coast PE type players who are playing in the venture space try and negotiate for a dividend, like a coupon, where it's this amount, and it may not have to get paid out, but it tacks onto their liquidation preference. That is, I think, A, not market, and B, you've got to really pay attention to that because it just really increases your liquidation preference and the amount of money that goes out the door before the common gets anything. So I would say kind of, no dividends is really kind of what you want. Liquidation preference, we already talked about this, right? This is the preferreds. Kind of, they're sitting at the top of the stack and they get paid before anybody else gets paid. This is just kind of longer language getting to the same point. Voting rights is saying the preferred, votes together with the common. Board of directors, this sets out what the board structure is, so that negotiated point. And you're seeing here, right, these are the same points, but instead of covering it in 2, it's covered in 10 lines. So it's just fleshing it out in more detail to make sure we're all in agreement. It's a stylistic thing. Optional conversion, the preferred converts to common, like we said, so that'll either happen at an exit or at any point. The preferred could elect to convert if they wanted to. You typically don't see that. You could see it in some contentious situations where maybe there's board seats assigned to common and the preferred convert some of those shares to gain control of that seat. There's kind of some corner cases there. But think of preferred, it's convertible preferred stock, meaning it can convert into common stock. And there's certain scenarios where it's going to automatically convert, and there's 2 common scenarios. One is upon an IPO of a certain threshold. When companies go public, they almost always go public only with common stock on their books. You don't have preferred stock at an IPO. You may see companies put it in place later. It's almost like this sort of coupon or dividend type thing we talked about. But a company that's going public for the first time, it's almost always just with common stock. And so you need those preferred holders to convert their shares to common. And so this is saying if we do an IPO with at least where the company raises at least $30 million, which is a small IPO, then all that preferred becomes common stock. It also can convert in a majority. So the preferred at any point as a class can get together and say, all of us will convert our shares to common. That can be important for sometimes if you need to recapitalize the company or restructure things. Having the ability to act by that vote can be important. Okay, anti-dilution protection. So this is something that is very standard. It was not in those Series C terms we talked about first. This is kind of an enhanced right that is important, but it's one of the things that was stripped from that Series C in the interest of kind of simplicity, but now we're seeing it come into play when you do the full set of Series A. This is a lot of language, but at its essence, what it's saying is if you raise a Series A today and you sell me Series A shares at $1 a share, if you then go along after and you raise a later round at less than $1 a share, I get to be made whole for that. And so it's what we call dilution protection. It's not dilution protection in the sense that, if you raise money later in an up round, people's percentages are going down. It's not it's price-based dilution is what you're trying to solve for here. And so there's exceptions, like you can issue shares that are less than $1 a share to employees or maybe to Silicon Valley Bank. So there's a whole list of exceptions, but what it's preventing against is a down round. So it gives it's not preventing you from doing one, it's just giving your investors protection in the event you have to do a financing later at a lower valuation. And so what happens then is their conversion ratio gets adjusted. So remember we talked before about every share of preferred converts to a share of common. If you've never done a down round, then that ratio is 1-to-1. Each share of preferred becomes 1 share of common. But if at some point you've done a down round such that this dilution protection kicks in, then that ratio has changed. And every share of preferred, which had the dilution impact, converts into more than 1 share of common. And how many more shares depends on a complicated formula of how much more money you've raised and what the price difference is. But at its essence, it makes the investors whole for the fact that they paid a higher price than later investors. So this is very standard, and it can have a really dilutive impact if you do down rounds later, because you've just had a whole bunch more shares come on the table. So it's no longer 1 for 1. That share of preferred is now, let's say, 1.3. And so it can be very dilutive to the team. You know, you don't see a ton of down rounds. I just did one, but for the most part, you see them in really bad economic times where companies are forced to raise money at lower valuations than they had before. And this just gives your investors some protection. Okay, then there's a list of protective provisions. So this is a list we talked about before. It was a paragraph, and now we have it all laid out. It's like 2 pages. This is a list of things the company can't do unless the investors say it's okay. So this is a list of powers you're handing to them. Once again, it's not things they can force you to do. It's things that you need their permission to do. All right.
We're at the
Ira?
Yep. So one reason this term sheet is so long is actually because it's not a term sheet for just one document, it's a term sheet for 5 documents. One of these 5 documents is called the Investors' Rights Agreement. So investors, they get stock, and they also get certain rights in the company. And that's what this agreement sets out. So one of the first ones that we'll talk about here is the right of first refusal to purchase stock if the company's selling stock in the future. There are certain exceptions to that. They're pretty much the same exceptions as things that do not trigger an anti-dilution adjustment. So some things will, if you can issue stock in certain circumstances without getting lowering the conversion ratio and issuing extra stock to people effectively. There's a few exceptions. They're the same exceptions here, but other than that, people will have investors who are major investors, they've purchased a certain dollar amount, will have a right to purchase shares of the company as issuing them in the future, and it terminates at an IPO or at a liquidation event.
Just add one little point there, actually. When you raise a Series B, your Series B investors will expect that your Series A investors are going to buy a little bit of that round. And this gives them the contractual right to do that. It's not an obligation. It's just you're giving, they have the ability. But I think most Series B investors would expect that your Series A investors would buy some round because it has a strong signaling effect. And if your early investors are like, I'm out, I'm not buying another share in this company, I think that's a tough message to tell a new investor. So this doesn't obligate them to, but gives them the right to. It's something investors really care about. And so when you go raise your next round, one of the biggest things that gets negotiated is how are we dividing this pie? Let's say your Series B, you're raising $10 million, and your new investor wants 6 of that. Then you've got $4 million. So, okay, we've got existing investors who want a piece of that pie. We may have a strategic who wants to take a little. And you've got this dance you're doing about how you're allocating funds. But having early investor support, at least even in a nominal amount, has a very important signaling effect.
But to Kristine's point, it can also go 2 ways. You can have a scenario where a company is real hot,
Yeah.
and they want to let some other VC in and invest in their next round. But the other VCs are saying, no way, you guys are on a hockey stick, and you're growing like that. It's just going crazy. I'm taking my full pro rata right, and sorry, there's not any room for anyone else. That can also create friction. So it's like it can go either way.
Yeah, good point.
Is there a company's protection? Say, suppose you have a bad investor in Series A, and then he wants to control the company in Series B, taking more stock. Is there a way for the company to protect themselves from some bad investors which are not aligned with the company's focus?
I mean, not really. Usually, it's the voting is by majority. So if they control a majority of that Series A, you're probably going to have to deal with them. And so there's no way for you to automatically kick them out or anything. At least that wouldn't be something I've seen. So this goes to the point of being very careful who you let into the company because you're going to need their votes in the future. Yeah.
Another thing that companies will give major investors is information rights. So they'll give them financial statements. They'll give them their annual budget. They'll say you can come to, visit our facilities. These can be very custom. In a situation you talked about corporate VCs before, oftentimes they'll have very specific information rights that they'll want. But then the company, in a pharmaceutical context, won't want to tell them everything. If you have a big pharmaceutical company investing in a startup that's developing something, how does a startup know that the big company doesn't have a similar clinical trial going on? So you start to get into, this can actually be very heavily negotiated. There can be carve-outs. There can be limitations on information provided to some investors and not others. So it's something to consider. There's a lot that revolves around this. This is by no means a standard, well, it's a pretty standard list, but it can grow or be smaller.
This is sensitive, right? You're a private company, so your financials are not out there on the SEC website. Hardly anybody has them. So you have to be careful who you give these rights to because, yes, they're under NDA protection, but, NDAs are things you have to enforce. And so you have to be careful who you're handing over your information to. And so to Pat's point, when you get into like strategics investing or people you think might eventually buy the company, this gets much more sensitive. And I've seen days of negotiation just around what information rights are. But it's a reasonable request from investors because most VCs, for example, they have their own investors to answer to. And they have to tell them how the company's doing, what the company's current value. So, there's a real business reason that your investor, most of them need this information. But it's a matter of controlling who gets it and what they get.
Does that mean that you're saying that the VC, say suppose Johnson & Johnson is buying one of the startups, does that mean that the VCs will know that the company is negotiating with J&J to be bought out when the negotiations are going on regarding the purchase price and everything?
So the board members will definitely know, and some of your investors will have a board seat. And so in the early days, yes, your board will know. At a certain point, you need to tell your stockholders too, because they need to approve the deal. But that usually comes a little bit later. Yeah.
But one thing a corporate might negotiate for is they might say, we like you guys, we want to buy you, maybe, but not yet. But if someone makes an offer to buy you, you have to tell us right away, like right then, that they did that, and then we're going to be able to step in and negotiate as well and participate. You can't just sell yourself behind our back. So that, the good lawyer like us, you can. There's really no limit to the kind of the tweaks you can make and the way you can structure these rights. That's one that you'll see come up sometimes.
Yeah.
Along the same lines, is there anything stopping like Johnson & Johnson in that case to just buy straight from the VC, like that common share they have?
It's a great question. You got the question right. Yeah. So sometimes yes. Some companies, so it used to be that shares in a private company were, you could just sell, anybody could sell them. And that was in a world where I think there were less players in the private tech world, and in a world where the path to exit was shorter. So like within 5 or 6 years, companies were going public or getting sold. That window is now much longer, and there's a lot more players in the tech world. And so what we've seen, and actually we, as a firm, we did this for the first time with Facebook when we worked with them, is transfer restrictions put in place. And you see this now with most tech companies you've heard of have these. And what they are is they're a rule in the company's bylaws which say stockholders can't sell their shares unless the board says it's okay. And it's to prevent people coming onto the cap table that the company doesn't want on the cap table, and it gives companies control over who their stockholders are. So that's a very common thing. And you're seeing, for example, and this is in the news, you hear SoftBank is investing in Uber and they're potentially buying shares from employees. The company's facilitating that because nobody can sell their Uber stock. But what will happen is if there's restrictions in place, sometimes the company will recognize that in certain circumstances it makes sense for shares to change hands. And they'll waive these restrictions and they'll do that. But without these restrictions in place, or any agreement, then people would be free to sell their shares, which is not a good situation. Yeah.
Isn't there a private exchange where this happens, where it used to happen, like you can sell shares?
Yeah, there's things like Shares Post. I think Second Market is now owned by NASDAQ. I'm not sure they exist, but there are these exchanges. But quite often there's restrictions in place, so these transactions cannot happen unless the company agrees. And so now, actually, every time we incorporate a company, we have a standard checklist that our founders fill out. And one of the items on that checklist is, do you want to put in place transfer restrictions? Because the best time to do it is actually on day one. Because this is a technical point, but I think it's interesting. What Delaware law, in most companies we incorporate in Delaware, what Delaware law says is you can put these transfer restrictions in place at any time, but you don't bind anybody who already owns their stock. So it's just prospective looking. And so if you wait too long to do it, then you've got all these early people who are not bound by those restrictions, and you just catch the later folks. And so, if you're going to do it, I think earlier is better, because then everybody who comes after is bound. But it means the founders are bound as well. And some founders are less comfortable signing themselves up to that. I've also seen some investors say, we're going to put this restriction on the common stock, but we don't want it on the preferred stock. I think that's mostly a losing argument. And I think most times, I think it's fair for the founders to say, if we're going to be bound, then you're going to be bound, and we're all going to ride this out together. I think in most cases, if you have a restriction, it's everybody. But there's nuances here in terms of who's locked up.
I mean, I was thinking of if the VC firm is running out of business or something and they want to sell their shares and then...
Yeah.
Yeah.
But then the company will facilitate that. I mean, they have an
Unless we're
interest.
about to talk about
Yeah,
registration
exactly.
rights.
Oh, on an IPO.
Well, and so this next section,
We just breeze over.
yeah,
it, I
I'm going
think.
to blow through this really quickly because it's incredibly boring and very technical, but it has to do essentially with, one of the scenarios is a scenario where you have an investor who wants the company to take an action that will let them get liquidity on their shares, register their shares with the SEC, that they can be sold freely. It's not shares in a privately held company. You can't, it's much more difficult to sell those than it is one that's a registered security. There are forcing mechanisms for that. There are ways for people to join in when others have a registration statement in respect to their shares. It's really probably, certainly by far my least favorite part of the whole thing is reading these provisions because it's very dry, but one that is a little interesting. You might have heard about things, for example, like Snapchat's lockup period, where Snapchat common holders, they IPO'd, but you IPO, you can't just start, Evan Spiegel couldn't just unload all his shares right away. And you see it in the news, people saying, oh, look, we're watching the share price for the day the employee lockups start to end. It's basically to give stability to the price after the IPO, so the common holders, they can't sell their shares for a certain number of days afterwards, and it just basically helps the underwriters be able to make the case to the initial purchasers who are going to buy the shares. So an underwriter goes out and says, I'm doing the Snapchat IPO. Do you guys want to buy some stock? And people usually say, oh, yes, for sure. And the underwriter, though, needs to be able to say to them that the price is not that I'm offering it to you at is not going to just plummet on day one. So this is that mechanism. And in order to enforce this, you need to have everyone signing an agreement in respect to their shares where they do agree to get locked up. It's very important to have those in place, because if you don't, you might get in a scenario where, what do you think, some common holder, you get close to an IPO and you come, hey, well, by the way, can you lock yourself up voluntarily if we forgot to get these signed? I mean, if you look at some tech IPOs have performed, they might say, no, I'm selling it right away, day one. I'm going to take that pop that usually when they offer it, I'm going to sell it right that moment and I'm out. It's a technical point, but it's an important one, and it goes to show that it is important to make sure employees of the company all are signing. You're not trying to make people's equity impossible to deal with or anything like that, but you do need to protect the company as well. So it's very important to look at that side of things when you're issuing common stock to people, whether it be an option or a restricted stock.
It's why you need people on good standard paperwork that a law firm can help you with, because you gotta from day one have these right terms and restrictions in place, because they actually, I know people think, oh, it's like legalese and lawyer stuff, but it actually does matter. And so you bind them because when they get their shares, the document by which they get their shares puts these restrictions in place. And so it's important to do that. Okay, voting agreement. So we talked about this. This is just setting out once again what the board structure is. So one of the most important things to focus on is how big is the board and who controls which seats. So heavily negotiated. Something called a drag along. What this effectively gets at is there's going to be certain scenarios where if the big people around the table, so the board always, and then certain holders, so probably a majority of your common, a majority of preferred, if they decide that the company is going to be sold, then all the little people have to go along with that sale. And so what this is trying to prevent against is a scenario where you have the biggest holders at the company who want to sell, But most likely, most buyers will say, we want 98% of the people agreed to this deal. They don't want people who are exercising dissenters' rights or resisting the deal. So they're going to say, as a condition of us closing, we want 98% of your cap table signed on to this deal. And this is often the mechanism that helps you do that. So your majority of your preferred agreed to sell, a majority of the common agreed to sell, the board agrees to sell. All those other little people, they have to agree to sell now too. At its essence, that's what it is. Okay.
Another agreement is the right of first refusal and co-sale agreement. It's different right of first refusal than the one we talked about where investors have the right to buy shares that the company is issuing. This is a right of first refusal that applies specifically to the stock held by the key holders. The key holders are people who hold large amounts of common stock. So it's usually like the founders and very important employees. But it could be. It depends where you set the limit, but generally the founders. We'll say the founders are the ones who you're going to always have subject to this agreement. The company has a right of first refusal to purchase the founders' shares. Founders cannot just go sell their share to anyone. They have to first offer it to the company. And if the company doesn't exercise it, the investors will have a right to purchase those shares as well. There are some exceptions that allow founders in some cases to do things like family planning, or estate planning, sorry, family planning is something else.
That's a later class.
We don't cover that in this one. And here you see we've got an exception if they want to donate it to charity. That's one you'll see sometimes. And then the right of co-sale is if the founder offers the company the common stock and the company does not purchase it and the founder goes to sell it to someone else, they actually have to allow the investors to participate as well in the sale. So,
I want to say on a practical point, when a founder wants liquidity, and by the way, we see this quite commonly, where a company that's doing well and it's raising a Series B, C, or later, quite often the founders also sell some of their shares to the investors and take a little bit of money off the table. Very common scenario. So there's these contractual rights in here where the investors have the right to first buy them, and then if they don't want to buy them, they have the right to sell some of their shares instead. In most cases, we get agreement on how we're going to proceed. And people waive their strict contractual rights and recognize it's in everyone's interest for the founders to take a little bit of money off the table. What I find interesting there is even in the time I've been working with startups, it used to be that the thought of a founder selling some of his or her shares before a sale or IPO was like a crazy thing. Investors would think that's like a terrible scenario. It's like you're locked in, you sell when everybody else sells. That has really changed, which I think is quite interesting. I think it's also a reflection of the fact that the path to exit is, the road to exit takes a little longer. But the thinking now is, look, if a company's doing well, it's in everyone's interest to have the founder have a little bit of financial stability. And so it's usually like less than $5 million, which I know is still a lot of money, but it's, compared to the person's wealth in the company, it's a small fraction of that. But the thinking is, look, give these founders some financial security so that they can pay for their home, put away money for their child's college, not have to be stressed about money every day. And as a result, they can actually have increased focus and commitment to the business. And I think that's valid. And so you're seeing that phenomenon play out. And so quite often as we see these secondary sales where founders take a bit of, I just did one where the company raised 35 million, and 10 million of that actually went to the founders directly, and the rest of it came into the company. So kind of an interesting phenomenon that we're seeing.
You're up, SPA.
Yeah, I think we'll skip over that.
Then it's okay. So I think this is
We're
the
almost
last.
done, but
This is the last section of the term sheet. So this is where you have what are called business covenants. We kind of talked about them in the Series Seed. If you have an outside investor putting someone on the board, they usually want their director to have what's called director indemnification, which basically means that they're not going to get sued to pieces for something by other investors because of an action taken by the board, and that company has to act through the board. So if an investor votes in favor of something, it turns out to be disastrous, you could imagine a scenario where they would say that you breached one of the duties under the law. This is a robust area of corporate law that directors owe to the company. They have to act in good faith, they have to be informed, they have to be loyal to the company, and so these are all also very common causes of action for lawsuits that directors do not want to face and do not want to pay for. So very common. If you have a VC, you have to have them indemnified by the company against things like that.
And the company has to go get directors and officers insurance.
And insurance, yeah.
Yeah, typically you don't see that until you have like an investor join the board, and then it's a completely standard ask, like $2 to $5 million.
Yeah, you're probably not going to get away without that. You're not if you have an outside investor coming in on the board. Employee agreements, another one. The company, you want to make sure the IP is protected, and so one of the things you'll say here, but it'll become a rep in the stock purchase agreement, is that all the employees have signed agreements assigning the IP that they've created to the company, and that there are no exceptions. And then so because it's a rep in the stock purchase agreement, if there are exceptions to that, if there are people who, for one reason or another, haven't signed an agreement like that, or who have brought exceptions to the IP that they create being assigned to the company in their agreement, the company will have to inform the investors of that, or they'll breach their reps. So, and you don't want to do that. You want to make sure the reps are all true and accurate. And so the way that's probably something not for this session, but there's a whole part of the stock purchase agreement where you basically give pieces of information about the company. They're called disclosure schedules, and that's something that you would see appear on the disclosure schedules. In this case, employee X worked at a company before, developed this patent, and this is a patent that has been assigned to that other company. It's not ours, and so.
This is a good example of why having the right documentation in place and doing things early on matters, because it matters when you raise money, because investors care about it. So this agreement here that all your employees have signed an agreement assigning IP to the company, I think people think, oh, blah, 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 lawyer stuff as we're incorporating. It's important, actually. You need everybody to sign these agreements because your investors are going to ask you about it. And it's too much work later to go get people to sign it later or track down Joe, who's now backpacking through Asia when he used to be an engineer. It's just not doable. You've got to have good systems in place to get all this stuff signed at the right time so that when your investors ask about it, you just show it to them and, no issues. This stuff does come back to haunt companies who don't have good hygiene.
And me, because I have to fix it. We've had a lot of clients where this has been and it's expensive to do because
Yes.
Then I have to go look at all your agreements. I have to check all your employees, and I have to make sure everyone signs something. And the ones who didn't, I have to get them to sign something. And that's not the only thing that they need to sign to make sure things are clean and tidy and in the way an investor is going to want it to be. So you don't save any money at all by not doing it in the front end. You actually make things much more difficult for yourself. You end up delaying the financing because investors are not going to want to, if they have some very important engineer hasn't assigned its IP to the company, who is going to want to close on that? It's just not a good situation to be in. So that's our plug for doing it right from the beginning. Vesting, again, your investors will often ask to make sure that employees are subject to vesting, subject to standard vesting. They'll want to know if people have what's called acceleration, which means that if the company gets acquired, for example, this is rare, this is called single trigger. If the company gets acquired, then all of a sudden all the stock is vested right away. And then so, they have the vested stock and they would get the acquisition proceeds as a result of having fully vested stock. Or double trigger, which is if the company is acquired and then they get fired for some reason that's not because that they were acting poorly. That's another kind of acceleration you'll sometimes see, and it's a way for people to protect themselves. Founders generally would get this. Only very, very top level people in the company you're going to want to provide this to. Otherwise, it makes things very complicated. If you do have an exit event, board members, all reasonable out-of-pocket travel expenses. So, they can go to normal restaurant, I guess, not Jean-Georges every night for the board meeting. Legal fees and expenses, confidentiality, non-solicitation. I think these are all things we've
talked about
discussed.
that before. But
Yeah.
you see here, like the investor reimbursement went up to 35. This is a more complicated deal, right? So there's more lawyer time, and so you're not reimbursing $10K for their lawyer, investing 35, and so that tells you probably your company fees are going to be somewhere in the neighborhood of 70. Just for budgeting reasons, it's good to keep these things in mind. So. Okay, that's all you wanted to know about term sheets. Do you guys have questions before we leave? About this or anything else? We're happy to answer if you have other questions on startup stuff. Yes?
So we need to pay this $30,000 back to the...
Well, this will be negotiated, but yes. Yeah.
To pay also for our
Yeah,
lawyers.
exactly.
It's roughly what?
Usually 2x that number. Yeah. Yeah. No
The
question.
last question can't be about fees.
I know,
No,
that's so
come
boring.
on,
Don't leave us
guys.
hanging on that one.
We
That's
are
terrible.
worth every penny.
The company needs money quickly. Are there mechanisms by which you get money in and then finish all the paperwork, or how does that work? I know I don't even think we had a formal deal for a convertible note for my company.
Yeah.
Until like much later.
Right.
It was like a term sheet and a check. So like, how does that work? Or
Yeah, I think if you're talking small amounts in the early days, I have seen people like on good faith send you the money and then they sign the paperwork later. I think that's not realistic when you start to talk about big dollars and professional investment funds that have their own rules. So I see that with like friends and family early on. We have done some rounds where you have a big VC or even a small VC, but a professional investor who's signed a term sheet with you and they know it's going to take 3 to 5 weeks to get us to closing, but that you have payroll to meet in the interim. And I've seen in that case we can do like a quick promissory note where they'll put a few $100,000 in as kind of an advance on this. So there are mechanisms to do that. But the more money you're raising and the more sophisticated the players, the more formal all that becomes because people they have other people to answer to. Yeah.
I have a question on anti-dilution, and is it the same as full ratchet and partial ratchet protection?
Yeah, it's a good question. So we talked about that dilution, right? Where if you do a down round, that conversion ratio is no longer 1-to-1; it becomes something other than 1-to-1. There's different flavors. There's broad-based weighted average, which is this kind of the standard, or I would say market, and that is more company favorable. So it looks at other things. It looks at how much more money you raised and how big the delta was between what they paid and the new price. Full ratchet is much more punitive for the company. It basically means that you get much more dilution adjustment for the investor. That is, I don't see that very often. You may see it in like really bad economic times, but almost always it's broad-based weighted average.
That was my next question actually. In the common practice that you're seeing, so do you still see full anti-dilution protection or just?
Do you mean full ratchet or?
Ratchet, do you in the common?
I can't think of a deal I've seen in years that had that. Yeah, if you go, we publish a quarterly, if you really want to geek out on this, we publish a quarterly survey. It's on Fenwick West website where every quarter we look at all the venture deals done across the country, not just our clients, every single like venture deal. And we plot these terms. And so you can actually go and see, okay, of the deals in I guess probably the Q2 survey is up now. The Q2 survey of all the deals done, what percentage had full ratchet? I bet it's like 2 or 3%. So you can see on every key term where the market is at and where it was the quarter before and where it's trending. It's really useful when you're negotiating a term sheet and you have an investor say, oh, this is totally market. And you can say, actually, it's not. If you look at deals done last quarter, this was in 5% of deals. So it's kind of interesting information. It's on our website. Cool. This was fun. Thanks, everybody.
Thank you so much.